Take a moment and look carefully at what the market is actually reacting to right now, because this is not just another red day on Wall Street. As of the latest session, all three major U.S. indices slid more than 1.5%, the Dow down roughly 739 points, the S&P 500 off about 1.52%, and the Nasdaq falling close to 1.8%. On the surface, it looks like a typical risk-off move, but beneath the charts, something deeper is unfolding. Oil surged almost 10% in a single session, with Brent touching around $100 a barrel and WTI near $95, after Iranian attacks on tankers and renewed threats to keep the Strait of Hormuz restricted. The International Energy Agency is already warning that this could become the largest supply disruption the oil market has ever faced. And that matters because energy is not just another commodity, it is the bloodstream of the global economy. When energy spikes, inflation rarely stays quiet for long, which is why investors are suddenly questioning whether the Federal Reserve meeting on March 17th will still fit the comfortable narrative of rate cuts later this year. In moments like this, markets stop reacting to headlines and start repricing the entire system, and that repricing may only be beginning. Now let's move one layer deeper, because the real story did not begin on a stock chart, it began in a narrow strip of water most people rarely think about. The Strait of Hormuz. Over the past days, reports confirmed that Iranian forces attacked two fuel tankers while Supreme Leader Mojtaba Khamenei signaled that the passage could remain effectively closed. For the global energy system, that is not a minor geopolitical headline. Hormuz carries a massive share of the world's oil flows, and when that artery tightens, the entire market feels it almost instantly. That is exactly what we saw. Brent crude surged roughly 9.2%, closing near $100.46 a barrel, while WTI jumped about 9.7% to around $95.70, the sharpest one-day move in months. According to the International Energy Agency, the conflict is now threatening what could become the largest oil supply disruption the global market has ever faced. Think about that for a moment. When supply chains for energy begin to fracture, inflation stops being an abstract statistic and starts becoming a structural force again. And suddenly the conversation shifts from growth to security, from optimism to risk. Because once energy becomes unstable, the rest of the financial system eventually follows. And that realization is beginning to ripple quietly through every major market. But once that shock moved through the energy markets, the next reaction was almost inevitable. Capital began moving quickly and without hesitation. On Wall Street, the shift was visible across the entire board. The Dow Jones Industrial Average fell about 739 points, roughly 1.56%. The S&P 500 dropped around 1.52%, and the Nasdaq Composite slid nearly 1.78%. What makes that move important is not just the percentage decline, and that realization is beginning to ripple quietly through every major market. On the NYSE, declining stocks outnumbered advancing ones by roughly 4 to 1, while on the Nasdaq the ratio was close to 3.3 to 1. That kind of market breadth tells you something deeper than a simple correction. It tells you investors are repositioning. When geopolitical risk intersects with energy shocks, portfolios begin shifting away from growth expectations and towards survival assets. Even within the index, the industrial sector dropped about 2.5%, reflecting fears that higher fuel costs could ripple through manufacturing and global supply chains. In moments like this, markets are not just reacting to news, they are recalculating the cost of operating in a world where energy suddenly becomes uncertain again. And once that recalculation begins, it rarely stays confined to equities alone. And this is where the conversation shifts from geopolitics to something far more sensitive for markets: inflation. Because behind every spike in oil is a silent question investors are already asking themselves: what does this mean for the Federal Reserve? The next policy meeting on March 17th suddenly carries a different weight. Only weeks ago, markets were comfortably discussing the timeline for rate cuts later this year. But when Brent crude approaches $100 a barrel and WTI surges nearly 10% in a single session, the math begins to change. Energy feeds directly into transportation costs, manufacturing input prices, and eventually consumer inflation. The irony is that the most recent inflation readings suggested price pressures were beginning to stabilize. Yet the 13-day conflict involving Iran and the disruption near the Strait of Hormuz have not even been fully reflected in those datasets yet. That gap between data and reality is exactly what investors are trying to price today. Strategists like Ryan Detrick have already pointed out that as oil rises, the probability of Fed rate cuts later this year declines quickly. And when that realization spreads across markets, the narrative quietly evolves from expecting easier money to preparing for a world where policy may remain restrictive longer than anyone anticipated. And while equities were adjusting to that new reality, another signal began quietly emerging in the currency markets. Capital started moving toward the US dollar, a pattern we often see when uncertainty spreads through the global system. Over the past sessions, the dollar index climbed toward its highest level since November, putting the currency on track for a second consecutive weekly gain as investors searched for stability. At the same time, the euro drifted near its weakest levels in months, while the Japanese yen traded around 159 per dollar, a range that has historically raised concerns about potential intervention from Tokyo. These moves may appear technical, but they reflect something deeper about how markets interpret risk. The United States remains a net energy exporter, which gives the dollar an unusual advantage during periods when oil prices surge toward $100 per barrel, as both Brent and WTI recently did after the attacks near the Strait of Hormuz. In other words, the same shock that pressures global growth can simultaneously strengthen the currency at the center of the financial system. And when that dynamic begins unfolding, it quietly reshapes capital flows across every major market, something investors everywhere are starting to recognize. But if we pause for a moment and look beneath the surface of the headlines, another layer of the story begins to appear, one that has less to do with oil and more to do with the structure of credit itself. Because rising energy costs do not move through the economy in isolation. They travel through financing conditions, corporate balance sheets, and eventually the credit system. Recently, Partners Group, one of the major private capital firms, warned that default rates in private credit could potentially double over the coming years if financial conditions tighten further. At the same time, Morgan Stanley reportedly restricted withdrawals from one of its private credit funds, while JP Morgan Chase marked down the value of certain loans tied to similar vehicles. On the surface, these developments may seem unrelated to events in the Strait of Hormuz or the spike in Brent crude above $100. But markets rarely operate in isolation. Higher energy prices increase operating costs, pressure margins, and complicate refinancing for companies already carrying significant debt. Over time, that pressure works its way into the credit markets. And when credit begins showing stress signals, investors start realizing that what initially appeared to be a geopolitical shock could evolve into something broader, a shift in financial conditions across the entire system. And when events like this begin pushing markets toward instability, governments rarely remain passive observers. Policy responses start appearing, sometimes quietly at first. According to reports, the administration of President Donald Trump has already asked U.S. energy and shipping companies to prepare for a potential temporary waiver of the Jones Act, a century-old regulation governing domestic maritime transport. The objective is simple: keep fuel and agricultural shipments moving between American ports if supply disruptions intensify. At the same time, Washington issued a general license allowing certain Russian crude and petroleum products to be sold through April 11th, a temporary step intended to ease pressure on global energy supply while the conflict with Iran continues. Meanwhile, the International Energy Agency, IEA, has taken the extraordinary step of approving the release of roughly 400 million barrels from strategic reserves, the largest coordinated drawdown ever discussed. But even that number carries an uncomfortable reality. Analysts estimate that such reserves would offset only about 20 days of disruption if flows through the Strait of Hormuz remain constrained. In other words, policymakers are not resolving the underlying problem. They are buying time, hoping markets stabilize before the structural shock spreads further. And whether that window of time proves sufficient may determine the direction of the entire financial system in the weeks ahead. And when you step back and connect all of these signals together, a larger pattern begins to take shape, one that markets have encountered before. Periods of geopolitical tension in the Middle East have historically triggered powerful oil shocks, and those shocks tend to ripple far beyond the energy sector. In the 1970s, after the Yom Kippur War, oil prices surged dramatically as supply routes tightened, and the global economy entered what later became known as stagflation, a difficult combination of rising inflation and slowing growth. Today, the ingredients look strangely familiar. Brent crude is approaching $100 per barrel, WTI near $95, stocks are turning volatile, and policymakers from the Federal Reserve to the International Energy Agency are facing a far more complex environment. Analysts such as Gavin Friend of NAB have already warned that markets are beginning to focus less on diversification and more on the dangerous mix of higher inflation and weaker growth. That shift matters because when the economic narrative moves in that direction, every asset class from stocks to currencies to commodities must be reevaluated. And history reminds us that when energy, inflation, and geopolitics converge at the same time, financial cycles rarely unfold quietly. They tend to reshape the entire investment landscape in ways few participants initially expect.